I'm here at the Dallas Federal Reserve Bank with Dallas Federal Reserve President Robert Kaplan at an opportune time. Thanks for joining us, President Kaplan.
Welcome to Texas.
Okay, so yesterday, as Joe was just talking about, the market moved on the minutes, and I think there were two things that were in there. One was this discussion of symmetry, and the other was this discussion of the long run. So if we could take those one by one, what's your sense of how symmetrical the Federal Reserve will be? How far are you comfortable letting an inflation run above a 2% target?
So my own view is that we don't want to run persistently above 2% or persistently below. And what that means is if you have some short-term excess above 2%, I'd be willing to tolerate that. If I thought we were going to persistently run above 2%, that would affect my policy views. And so that's my view on the 2% symmetry issue.
I did some calculations. To be truly symmetrical, you guys have to be at 2.7% for like 6 years. Do you have that kind of tolerance?
So it's not historical symmetry. In other words, you don't need to have a catch-up. We've had 7 or 8 years of an underrun. We don't need to have a catch-up. When I say we don't want to run symmetrically above or below, we can run a little bit above or a little bit below, and that's fine. But we're not trying to catch up for historical underruns.
So is 2.5 a top for you? Is it 2.25? Where would you say that tolerance level is?
I'd still say I want to run around 2. And if we got a little bit above it, and I thought it would be short-term, not long-term, I could tolerate that. If I thought it would persist, I think it would affect my policy views.
The minutes yesterday said that there are a few people who think the Fed will be at the neutral rate before too long.
Yeah.
Are you one of those people that think that?
Well, as you know, I've said consistently, I think the neutral rate is somewhere in the neighborhood of 2.5, 2 3/4. If I had to narrow down the range, we're at 150 to 175. So it means basically after 3 or 4 more moves, we're going to be at neutral. My own view is we should be raising rates until we get to neutral. We should do it gradually. I'm not prepared to say yet I want to go above neutral. I think once we get there, we'll have to make that judgment at that time, whether it makes sense to be restrictive or what I think would be restrictive. I'm not there yet.
One of the interesting things always about coming to Texas and Dallas is oil prices.
Yeah.
They've been doing quite well. What does that mean for the Texas economy, and what do you think that means for the U.S. economy?
So we've been in a global oversupply situation, we think, through part of 2014 to 17. We think we're basically in global supply-demand equilibrium now, which means that we're growing global demand, but shale, particularly, should be sufficient to supply increases in global demand.
Sorry, can I just ask you, does that mean you think $70 a barrel is an equilibrium price?
I think we're going to have a lot of volatility, and here's why. So if shale's enough to supply global demand growth, the problem with shale is it's got a very rapid decline curve, and we have not been investing in long life projects. So we think over the next 3 to 5 years we'll be very susceptible to geopolitical shocks and some threats like we have now. The issue for us is not the next 3 to 5 years, it's beyond 3 or so years. We think we may well get into global undersupply situation. Why? Because as prolific as shale is, it may not be enough to supply increases in demand, and we haven't had long life projects. But for the next 3 to 5 years, we'd say we're in a fragile equilibrium where we're going to have sort of volatility around a range.
I got 2 more topics I have to get to. The first is one of the recent developments, and I think that's almost since the minutes as well, is what's been happening in emerging markets. Is that a risk, you think, for the Federal Reserve and for the U.S. economy, what's been happening in Turkey and Argentina and some of these other places?
Yeah, and I watch this carefully, and some people may say, why are you watching outside the U.S. so carefully? You're central banker to the United States. And the reason I do is, and just for people listening to this, what's happening is the dollar strengthens, and as the Fed raises rates, there are a number of countries that had rapid inflows when we kept rates very low. And with a dollar rising, they're very sensitive to increases in the dollar. Turkey, Argentina, for example, but it's a continuum. The reason I watch it is if that gets pronounced enough, that could lead to a rapid tightening in conditions in the United States, which in turn could slow the economy.
Are you concerned now about that?
No, we're not there yet. We're not there at all, but it's a developing situation. It's one that I think we need to be watching. And one indication is, first quarter of 2016, we saw this happen with China, and it caused a rapid tightening here, and we had to be aware of it.
We're here at a conference on technology and disruption in the economy.
Right.
Why is the Fed putting on a conference like this? Why does that matter to the economy? Why does it matter to monetary policy?
So the reason at the Dallas Fed we've spent a lot of time on this, and we're hosting this conference along with the Atlanta Fed, is we think technology replacing people is not a new story. It's been going on for decades. Because of distributed computing, the cloud, we think that it's accelerating. Consumers have much more technology at their disposal than companies did 30 years ago. And so the impact is the following. Companies have far less pricing power than they have historically. So we think it'll have a muting effect on inflation. We think that needs to be taken into account. And we think it's having an effect on productivity. And what I mean is because of the rapid disruption in industries and jobs, if you've got a college or better level of education,
right,
you can probably adapt to it. If you're one of 46 million workers in this country that have a high school education or less, you're seeing your job disrupted or eliminated. And if you don't get retrained, which is easier to say than do, you may see your productivity level decline over the course of your career. So we think it's affecting, it's one of the reasons we believe that productivity is sluggish in the U.S. economy, and we think more work needs to be done in understanding that.
Robert Kaplan, thanks for joining us.
Thank you, Steve.